Within the realms of traditional and crypto finance, lending and borrowing refers to the act of one party providing monetary assets, be they fiat or digital currencies, to another in exchange for a regular revenue stream. But let's understand DeFi lending and borrowing much deeper in this video. What is decentralized finance, DeFi? Cryptocurrencies have grown into a trillion-dollar business, causing a wave of financial disruption around the world. Cryptocurrencies have a long history of invention that dates back to the 1980s, when cryptography improvements were made. Since then, a succession of events has impacted the crypto world, the most notable of which is the first cryptocurrency, Bitcoin. Despite its meteoric rise over the past 12 years, financial services for Bitcoin have been reluctant to emerge, owing to its fundamental lack of stability and adoption. Because of its substantial price fluctuation, mainstream banks will not accept a Bitcoin loan, making Bitcoin a poor asset for accurately planning any investment. Things move fast in the crypto world, and decentralized finance, DeFi, is a hot topic right now. It is an exciting place to be sure. Now let's delve a little more into DeFi and discover more about it if you're still clueless. Let's explain decentralized finance, DeFi. Decentralized finance, or DeFi, is an umbrella word for a multitude of public blockchain applications and projects aimed at challenging the existing finance world. DeFi refers to financial applications built on blockchain technologies, generally employing smart contracts, and is inspired by blockchain technology. Smart contracts are enforceable agreements that are automated and can be accessible by anyone with an internet connection. They do not require any middleman to execute and can be accessed by anyone with an internet connection. DeFi refers to applications and peer-to-peer protocols built on decentralized blockchain networks that allow for easy lending, borrowing, and trading of financial instruments without requiring access rights. The Ethereum network is used in the majority of DeFi applications today, but many more public networks are emerging that offer better speed, scalability, security, and cost savings. What is lending and borrowing in DeFi? The concept of lending and borrowing has been around for a long time and is an important part of any financial system, particularly the fractional banking system that is widely employed today. The concept is simple. Lenders supply funds to borrowers in exchange for a regular interest rate, and that's all there is to it. A financial institution, such as a bank or an independent company, such as a peer-to-peer lender, has traditionally facilitated such transactions. Lending and borrowing in the context of cryptocurrencies can be accomplished in one of two ways: through a centralized financial institution such as BlockFi, Celsius, or through the use of decentralized finance protocols such as Aave, Maker, and others. Though decentralized to some extent, CeFi platforms work in much the same way as most banks, in that they take custody of one's deposited assets and eventually loan them out to third parties, such as market makers, hedge funds, or other CeFi platform users, while providing a steady return to the original depositor. And while this model appears to operate well on paper, it could be vulnerable to a variety of problems, including thefts, hackers, inside attacks, and so on. Decentralized finance protocols, on the other hand, allow users to become lenders or borrowers in a truly decentralized manner, giving them complete control over their finances at all times. This is accomplished through the use of smart contracts that run on open blockchain platforms like Ethereum, DeFi systems. In contrast, the CeFi can be utilized by anyone, anywhere, without the need to hand up personal data to a central authority. How does lending and borrowing work on DeFi platforms? A person uses a smart contract to transfer the tokens they want to lend into a money market, which subsequently issues interest in the platform's native token. When using DeFi protocols like Aave and Maker, users who want to become lenders must deposit their tokens in a money market. This is accomplished by sending one's assets to a smart contract, which acts as an automated digital intermediary, after which the coins become available for borrowing by other users. The aforementioned smart contract generates interest tokens that are automatically distributed to the user and may later be redeemed for the user's underlying assets. The tokens that are generated are native to the platform. For example, interest tokens in Aave are known as A tokens, whereas they are known as DAI in Maker. Almost the majority of the loans made possible by native tokens are over-collateralized, which means that users who want to borrow money must give a guarantee in the form of crypto that is worth more than the loan itself. While this may appear silly on paper because a person could merely sell their assets to earn the money in the first place, there are a number of reasons why DeFi borrowing makes sense. For starters, users may require funds to meet any unexpected bills they may have incurred, but they do not want to sell their assets because they're likely to appreciate in value in the future. Individuals can also avoid or postpone paying capital gains taxes on their digital tokens by borrowing using DeFi protocols. Finally, people may boost their leverage on particular trading platforms by borrowing funds from such platforms. Is there a cap on how much money one can borrow? Yes, and this is mostly determined by two variables. Is there enough liquidity on the platform? And what is a person's collateral cofactor or supplied assets? There is a limit, and the amount of money a person can borrow is determined by two main variables. To begin with, it is contingent on the whole fund pool that is actually available to be borrowed from a specific market. While this may not seem like a big deal, it might become a problem if someone tries to borrow a significant amount of certain token. Second, it is heavily reliant on the collateral component of the tokens provided. The total amount of money that can be borrowed based on the quality of the collateral offered is deferred to as the word on the DeFi lending platform. Compound, for example, DeFi and Ether have a collateral component of 75%, meaning that users can borrow up to 75% of the value of their DeFi or Ether. On a more technical level, borrowers must keep the total worth of their borrowed funds below the following limit: the value of one's collateral multiplied by the collateral factor. An individual can borrow as much money as they wish as long as this condition remains valid. What are the mechanics of how interest returns are doled out in DeFi? Using a DeFi app, one selects a currency to lend as well as a smart contract, and the interest amount is sent immediately to the Connect wallet. To summarize a long story, the interest that lenders receive and the amount that borrowers must pay is computed using the ratio between the supplied and borrowed tokens in a given market. In relation to a given market, it's also worth noting that the borrowed annual percentage yield is higher than the supply APY. On a more technical note, interest APIs are calculated per Ethereum block, implying that DeFi lending involves users receiving variable interest rates that fluctuate substantially depending on the lending and borrowing demand for specific tokens. Furthermore, some protocols, like as Aave, provides users with stable borrow APYs as well as flash loans with no upfront collateral. Are there any risks involved? DeFi protocols come with some hazards, such as third-party smart contract tampering and the possibility of borrow APYs skyrocketing in a short period of time. There are no practical risks connected with DeFi lending when compared to centralized finance. However, just like anything else, DeFi comes with its own set of risks. There are some smart contract concerns, for example, as well as the potential for APYs altering substantially in a short period of time. For example, during the 2020 DeFi craze, when yield farming was all the rage, borrow APYs on certain cryptocurrencies soared to 40% and higher. This could have resulted in unwitting consumers who do not watch their interest rates on a daily basis repaying more than they planned. Overall, while the process of lending and borrowing through DeFi platforms is not overly complicated, there are some minor distinctions in how each protocol operates, such as the wallets it supports, the fees it charges, and so on. Furthermore, users must exercise caution and ensure that they have entered the correct wallet numbers and address details in order to avoid losing their funds, as there is no way to recover them. Smart contracts have a wide range of applications, including DeFi, gaming, tokenized, real-world assets, prediction markets, transactions, and payments. Smart contracts in DeFi will continue to provide its consumers with user-friendly systems and financial independence as the way in which individuals and companies connect, share information, and use financial possibilities is changed by the latest technology. And, well, that's it for today, and we'll see you in the next one.